3 basic question every investor has. Which stochases to buy? At what price and when to sell them? Here's how the big bull of Indian stock market, Mr. Rakesh Jhunjhunwala, thinks about these questions.
Second, look at opportunity. Suppose I invest in Crystal. Look at the Crystal's opportunity for credit rating in India. It will rise as the financial markets rise. So there should be opportunity gives a large runway for growth. Then it's people. Technology, in the sense that people should be able to change. Corporate governance, frugality. Corporate governance includes everything. We are attitude towards society, towards the environment, towards the employees, towards your customers, and towards your stakeholders. And it's an attitude, right? So, opportunity, then there is a competitive ability. The company must have something superior, right? It could be technology, it could be brand, it could be capital. All this is at one side. The most important thing is what price you buy. It's important what you buy, it's more important at what price you buy. I made a lot of money in Mr. Malia's companies in 2000. When people say he's a thief, you will not own this, that. But I had 5 times my money in one go. And as far as selling, well, I will sell if I have a better alternative investment. But I will sell when I feel the stock has peaked out or the business model has peaked out. Right? But you must make every decision to sell an independent decision of buying. And don't please, flower your weeds and cut your roses. Just because of loss, I will not cut. मैंने तो कसम खाई है मैं नुकसान में कभी नहीं बेचूंगा. I think it's the biggest bullshit. So this is the way, and also, I learned a lot. I started unlisted investing in 2000. I lost a lot of money there. Then again, I invested in 2009-10. I lost money. Now, in my unlisted portfolio, I've done better than my listed. So those companies really taught me how businesses grow. What are the challenges, right? What is vital in a company? And see, finally realized one thing, Neeraj. I invest in a credit agency. I invest in a jewelry company. I invest in a pharma company. I invest in a communication company. I can't know everything about all the technical details. And finally, for a listed security, a limited amount of knowledge that can be shared by the management, right? So finally, we invest out of informed ignorance. Remember that. Because you are ignorant in the future and you are investing with informed ignorance. Both informed and ignorance.
Based on advice from expert investors, here is the simple blueprint to follow whenever you are making decisions to buy or sell stocks.
When evaluating whether to buy a stock, it's important to conduct a thorough analysis to make informed decisions. Here are the key steps to consider. Research the company. Begin by researching the company behind the stock. Examine its financial health, business model, competitive advantages, and market position. Review the company's financial statements, including the income statement, balance sheet, and cash flow statement. Look for consistent revenue growth, strong profitability, and healthy cash flow. Consider the company's management team and their track record. Assess the company's industry and potential risks or challenges it may face. Analyze the stock's valuation. Assessing the stock's valuation is crucial to determine if it's trading at a fair price. Calculate common valuation metrics such as price to earnings, PE ratio, price to sales, PS ratio, and price to book, PB ratio. Compare these metrics to industry peers and historical averages. Additionally, evaluate the stock's dividend yield if applicable. A stock that appears overvalued may indicate limited upside potential, while an undervalued stock might present a buying opportunity. Consider the growth potential. Evaluate the growth potential of the company and its industry. Look for companies operating in growing markets, with innovative products or services, and a strong competitive position. Assess the company's historical revenue growth rate and its future growth prospects. Consider macroeconomic factors that can impact the industry and the company's ability to expand its market share. Analyze industry trends, technological advancements, and regulatory factors that may impact the company's growth trajectory. Assess the risks. Understand the risks associated with investing in the stock. Consider both company-specific risks and broader market risks. Evaluate factors such as competition, regulatory changes, technological disruptions, and the company's reliance on key customers or suppliers. Assess the company's debt levels and liquidity position, as excessive debt can increase risk. Additionally, analyze geopolitical risks, economic conditions, and market volatility that can affect stock prices. Diversification across different sectors and asset classes can help mitigate risk. Review analyst reports and expert opinions. Consult research reports from reputable analysts and experts. These reports can provide valuable insights and different perspectives on the stock. Analysts often provide detailed analysis, price targets, and recommendations based on their expertise and access to information. Consider both bullish and bearish arguments to have a balanced view. However, it's important to note that analyst opinions can vary, so conduct your own analysis and use their insights as a reference rather than relying solely on them. When deciding whether to sell a stock, it's essential to conduct a thorough evaluation to make informed decisions. Here are the key steps to consider. Reassess the investment thesis. Begin by revisiting the reasons why you initially purchased the stock. Evaluate whether the fundamental reasons for investing in the stock still hold true. Has the company's financial health deteriorated? Are there significant changes in the industry or competitive landscape? Has the stock reached its target price or valuation? Assessing the investment thesis will help determine if it's still valid and if selling the stock is warranted. Review financial performance. Analyze the company's recent financial performance and compare it with your initial expectations. Review the latest financial statements, including revenue, earnings, and cash flow. Look for any signs of deterioration or missed targets. If the company consistently fails to meet financial expectations, it could be a red flag to consider selling the stock. Assess the company's profitability, debt levels, and liquidity position, as these factors can impact its long-term viability. Monitor industry and market conditions. Stay updated on industry trends and market conditions that may affect the stock's future prospects. Changes in the industry landscape, technological disruptions, or regulatory shifts can impact a company's competitive position and growth potential. Assess broader market conditions, such as economic indicators, interest rates, and geopolitical factors, as they can influence stock prices. If there are significant negative developments in the industry or market, it may be wise to reevaluate your investment and consider selling. Set clear exit criteria. Establish clear criteria or triggers that would prompt you to sell a stock. These criteria can be based on your investment goals, risk tolerance, or specific events. For example, You may decide to sell if the stock reaches a certain price target, experiences a specified percentage loss, or if there are changes in the company's management team. Setting predefined exit criteria can help you avoid emotional decision-making and ensure you make rational choices based on your predetermined thresholds. Regularly monitor and rebalance your portfolio. Regularly review your portfolio and rebalance it to align with your investment strategy. Rebalance by selling stocks that have become overweight in your portfolio or no longer meet your investment criteria. Regular monitoring helps you stay proactive in managing your investments and ensures your portfolio remains diversified. Consider the overall risk profile of your portfolio and whether selling a particular stock can help mitigate risk or free up capital for other investment opportunities.